Thank you, and I'm honored to follow my good friend from North Dakota. It took courage for the senator from North Dakota to be a leader on this issue in committee. The Banking Committee fought hard and long on this issue. I think there were 30 amendments that we discussed and voted on in coming to this bill that we're bringing to the floor today. And the senator from North Dakota was a shining star in that debate, one that reminded both sides of us what was most important, and that was the people back home. But she reminds me today of something that I had not come prepared to talk about, but I think it warrants merit. Citizens State Bank was my hometown bank. It's been bought and sold a few times. But my father, who was a school teacher and a school superintendent, actually was on that board. It was my first exposure to how banking works. And I remember going with my dad down, who was a school teacher and didn't make a lot of money, and he wanted a loan to buy a car. Now, at that time, I was a little older, but this was a 1954 Ford that my dad had been driving. I'm not really that old, but it was an old car. But he wanted to buy a new car. And I remember sitting off to the side and listening to the conversation. And when you talk about relationship lending could not go very long if that relationship lending didn't lead to a loan that got paid back. Well, the lending officer, I knew because he taught me in Sunday school. We saw him every week in church. His children went to the school where my dad was principal. So this is a different time today. I understand that. But the fact still remains that relationship lending, as the senator from North Dakota just reminded us, should be at the core of what we consider here when we're talking about this is a lending institution making a transaction with an individual to then pay that loan back. And that's what we tend to forget sometimes because of the debacle in 2008. But since Dodd-Frank became law, Mr. President, over 1,700 banks have been closed. Let me say that again. Since the Dodd-Frank law became law, 1,700 banks have been shut down. And most of these are community banks and regional banks. Entities that had nothing whatsoever to do with the financial situation in 2008. And while some of this body may see that as encouraging signs that big government now is getting more control of the lending principle in the banking industry, I think they're misguided. I think they're overlooking the real reality, that these 1,700 banks aren't the massive big banks that caused and the very few banks that had responsibility in the 2008 financial crisis. These are local banks, credit unions, regional banks, the banks supporting our Main Street, as the senator from North Dakota just reminded us, providing small businesses with capital and sponsoring Little League baseball games. I grew up in Little League like many members did here, and softball leagues and so forth. And right there in center field was that Citizens State Bank sign where they every year were involved in that effort in that community. Yet for nearly 8 years, those same small town entities have been hammered by big government regulations enacted by the Dodd-Frank Act. Credit unions, community banks, regional banks were simply not responsible for the financial crisis of 2008, period. And none of the draconian rules put on them make them more safe today than they were in 2007, Mr. President. These onerous rules have subjected the same regulation and compliance costs to these small lenders as are now being affected on the major 4 or 5 banks. Overall, it's estimated that compliance costs for community banks have risen by at least 20%. Mr. President, I think it's much higher than that. I met with a regional bank just this morning from Georgia, and their costs have gone up, their compliance costs have gone up $400 million because of Dodd-Frank. Now, that's money that could be in the community in the form of loans, and yet it's now coming in the form of higher compliance costs. Some of those are fines, by the way, Mr. President, coming to the federal government up here. That's another topic for another day that we don't address in this bill. This is eating up those small banks' bottom line and discouraging many community banks from offering some services to their communities, services that small businesses in Main Street rely on for capital every day as they try to grow. Well, what happens when a bank grows? Lending grows. That means small businesses growing. What happens when small businesses grow? Jobs are created. Compliance costs run just diametrically opposite to that dynamic and do not increase or lower the risk. The CFPB's qualified mortgage rule is a perfect example. This rule has driven many community banks actually out of the mortgage lending business altogether. So while it was intended to protect the consumer, yeah, it protected the consumer all right. It protected them from being able to get a mortgage. Government restrictions on reciprocal deposits is what's at topic here in this bill. Reciprocal deposits have created uncertainty around this critical lifeline for community banks and especially minority-owned banks that have specialized in serving customers with limited discretionary income and limited access to capital. Dodd-Frank is crippling the ability of community banks and regional banks to serve these communities. We recently heard from one community bank in Georgia that's not even established a residential mortgage department to serve the community because of these draconian compliance regulations. Why are they not doing this? Simply because the federal government, people in this room, decided a few years ago in the Dodd-Frank Act that they knew more about the free enterprise system, the capital formation dynamic, and the relationship between a lending entity and a borrowing entity, and how all that translates into jobs and economic growth. And because of that, we end up with this arcane Dodd-Frank rule that overregulates these small, regional, and community banks. Look, we're not trying to blow up Dodd-Frank. Many of us have taken a big step back in terms of what we think we need to do in terms of growing the economy in order to accommodate this bill. Many people on the other side of the aisle, I think there are some 14 co-sponsors on the other side of the aisle, and I applaud them for the courage that it's taken to work with us to get to a bill that we both give and take on. And look, the number one criticism we get in the Senate back home is that why can't you guys work together to get anything done? Well, here's a shining example. If we can get it across the finish line here and get a vote on this, we may have a tremendous example. We'll have a dramatic impact on Main Street back home. Small banks tend to spend too much time and resources dealing with the regulation and compliance costs that this Dodd-Frank law has created. Put simply, Dodd-Frank is just another one-size-fits-all Washington bureaucratic policy that hurts the very people it claims to champion, the middle class and the working poor, and those communities who have the least access to capital to borrow. Fortunately, we have an opportunity to do something today to fix these problems. The Economic Growth, Regulatory Relief, and Consumer Protection Act takes major steps to roll back Dodd-Frank's overreach. It will bring relief to the more than 5,000 community banks across the country. It will help free up capital for small businesses to invest in our economy and put people to work. It will help minority-owned banks, again, provide a wider range of services. In my state, Citizens Trust Bank is a minority-owned bank in Atlanta. Now, why is that important? You may have heard that bank. Martin Luther King Jr. was a customer of the Citizens Trust Bank. Martin Luther King Sr. served on its board. Many distinguished Atlantans and Georgians have been customers and members of the board of this auspicious bank in Georgia. Citizens Trust, though, has been forced to draw back their entire mortgage business because of the regulatory cost imposed by Dodd-Frank. Now, this is counterintuitive, Mr. President. Thanks to the action we're taking this week, the U.S. Senate Citizens Trust will be able to grow their mortgage business again because of safe harbor provisions in this plan, and Citizens Trust is not alone. Carver Bank is a minority-owned bank that has been serving Savannah, Georgia for 90 years, Mr. President. The restrictions and regulatory uncertainty on reciprocal deposits have limited its resources. This bill we're voting on this week will more than remove government restrictions on reciprocal deposits, meaning Carver Bank and Citizens Trust and many others will have additional lending capacity and lower compliance costs, which is another way to provide more capital to the community. This bill was written by both Democrats and Republicans. It's a shining example of what people back home expect us to do up here, our job. No, it's not perfect from my perspective. It's not perfect from the senator from South Dakota's perspective. But you know what? Between us, there is common ground here, and we found it. This bill will bring relief to rural communities and help small businesses, which will in turn grow our economy, something both sides want dearly. This bill also preserves and improves consumer credit protections. A vote on this plan is a vote for Main Street growth, obviously. It's a vote for rural communities and small businesses. It's a vote for people working with their local banks to secure capital so they can begin rebuilding the American dream. I commend my colleagues on both sides of the aisle for coming together in support of this bipartisan effort. I encourage every member of this body to think seriously about this and to support this bill in final passage. Thank you, Mr. Chairman. And I want to thank the chairman of the Banking Committee, the senator from Idaho. I can't tell you how much I appreciate your leadership. This has been a yeoman's effort, and I'm committed to seeing this through to cross the finish line and get a vote on this week. Thank you for your leadership.